One of the big questions we'll face during 2017 is whether this will be the year when we finally enter the long-awaited bond bear market. Now, following Donald Trump's election victory, investors are rightly concerned that the bear market may now actually be underway, with government bond yields having risen sharply. Ultimately, we believe 2017 will be a year in which bond yields rise in a volatile fashion, but one where we avoid a market crash. There have been three main reasons for the rise in yields, all of which can be put at the door of Donald Trump. Expectations of faster economic growth and potentially a faster pace of interest rate rises, a spike in inflation expectations, again related to the proposed fiscal plans, and finally increased compensation which investors are demanding given the greater uncertainty which Donald Trump brings. We think US Treasuries are unlikely to wholly decouple from global fixed income markets, and US Treasury bonds already offer a meaningful yield premium in comparison to other markets. It's highly unlikely there will be any monetary tightening in the UK, Japan or Europe during 2017, and by extension, yields in those nations will remain subdued, and we think they will act as a brake on the rise of US Treasury yields. Similarly, monetary policy will not be tightened aggressively in the US. So this implies something of a two-way pull on US Treasury prices, robust levels of headline growth on the one hand, but a cautious pace of rate tightening on the other. In terms of inflation, the trend appears to be one of gradually increasing pressures, but again, there isn't likely to be a significant rise in inflation readings. So far, much of the sell-off in bonds has been a result of the rise in inflation expectations. And this in turn reflects a consensus belief that Donald Trump will suddenly unleash a new wave of inflation as a result of his proposed infrastructure spending. However, there are very few infrastructure projects which can commence immediately. These plans take months, if not years, to implement, and there is still no guarantee that the actual level of spending will reach the proposed $1 trillion level over the next decade. The greater compensation required by investors to hedge against Trump risk does have some validity. The fiscal plans envisaged will lead to higher government debt levels. However, we're still not at the stage where overall borrowing levels are unsustainable. We just need to look at Italy and Japan. Faster economic growth may actually also help rather than hinder debt to GDP levels. Summing the situation up, we believe that yields will trend higher, but it's still too early to suggest there will be a plunge in prices.